Dear investor, Edelweiss Private Wealth Management is pleased to present you the latest issue of Investment Strategy Report for November 2018. Let's take a look at key highlights of October. India leapfrogged 23 spots to 77th position in the latest World Bank's Ease of Doing Business rankings, emerging as one of the top 10 improvers for the second successive time. The US economy continued its strong growth trajectory with 3.5% real GDP growth in Q3 calendar year 2018, making the US economy expansion 112 months old. The growth was led by acceleration in consumer spending and government spending. China's real GDP growth fell to the lowest level since the aftermath of the global financial crisis to 6.5% year-on-year in Q3 calendar year 2018 amid slowing infrastructure investment due to the ongoing deleveraging drive, weakness in manufacturing sector and ongoing trade war with US. Brent crude prices fell to $76 per barrel from its high of over $84 per barrel, prompted by rising crude inventories in US and assurances from Saudi Arabia to meet the shortfall in supply caused due to impending sanctions on Iran. India's forex reserves plunged to $395 billion from a record high of $425 billion seen in the earlier part of the year, primarily on account of RBI's intervention in the currency markets to support the rupee against an increasingly stronger US dollar. Nifty witnessed a sharp 8.5% fall during the month before recovering to end 5% down in October. Slowdown in funds from commercial papers as well as mutual fund redemption pressure is driving liquidity troubles and leading to pressure on the NBFC sector. Expectations of decline in NBFC credit, accounting for around 23% of total credit in the economy, have soured market sentiments and have led to a downgrade in growth expectations as borrowing costs rise. Nifty earnings is expected to grow by 10.1% in Q2 financial year 19, while top line is expected to grow by 14%. While volatility is likely to continue, pickup in earnings can balance other negatives and support market over medium to long term. EPS estimates for Nifty index for financial year 19, financial year 20 and financial year 21 are Rs 575, Rs 692 and Rs 788 respectively. As per blended estimates, index is currently trading at PE of approximately 15.6 times 1 year forward. We maintain our Nifty target range of 11,500 to 12,000 for December 2019. We recommend investors to deploy 33% of fresh equity allocation, while the remaining can get invested over a 5 to 6 month period in a staggered manner. The 10-year benchmark GSEC is hovering in the range of 7.81% to 7.95% on a semi-annualized basis. The volatility in yields has reduced recently as rupee stabilized versus the US dollar and crude prices cooled off from their highs. Trade deficit came to a 5-month low of Rs 14 billion in September 2018 as import growth slowed to a 5-month low, declining 10.5% year-on-year. Helped by government measures to curb non-essential imports, while exports declined marginally by 2.2%. RBI in its monetary policy meeting earlier this month maintained status quo while changing the policy stance to calibrated tightening from neutral, which leaves the window open for further rate hikes, conditional on the evolving trajectory of the rupee and crude. RBI conducted the open market operations purchase of government securities for an aggregate amount of 36,000 crores in October, taking the total OMO purchases to 86,000 crores in the year. It further announced 40,000 crores OMO purchase in November to ease liquidity pressure. We expect benchmark yields to remain volatile and trade in the range of 7.75% to 8.00% with an upward bias of 25 basis points. Yield movement here on will depend on inflation trajectory, currency movement, crude oil prices, and global bond yield movement. We recommend investors to allocate 100% of their fresh fixed income allocation to very low duration offerings, overnight and liquid funds, arbitrage funds, high quality roll down and buy and hold strategies, structured products, high quality bonds, and long term regular yielding infrastructure strategies.